Probably the number one question I get asked is, should I be doing Roth conversions? And a lot of people are concerned about rising higher taxes with all this national debt and inflation. In this video, I bring on expert, best-selling author David McKnight. He addresses everything coming up. Welcome to today's video. I'm so excited to have my guest, David McKnight, on. David is a best-selling author. He's an incredible, prolific person who's out going around the country trying to help people to prepare for what's coming in our economy with our national debt and to prepare tax-wise. He is, in my mind, the leading authority on tax diversification and helping people in retirement in that area. And I'm so grateful to have him on for our video today. David, thanks for joining me.
My pleasure.
Hey, before we jump in, I just want to tell the story of how we met real quick. So it was pretty cool. I was invited to go. I get invited to go to all these conferences, and people are always calling me to, sell me tickets to events. And they had this event in 2019, and the team called me up, and they were trying to get me to go and buy tickets and, all the extra stuff. And I was kind of reluctant at first. I didn't want to take time away from my business. And then they said, well, Dave McKnight's going to be there. And I said, okay, I'm going to meet David. So that's what ended up pushing me over the edge. And before we start, I want to tell you that, I genuinely am a huge fan of your work. I got everything here except for Volatility Shield. I just gave that copy away to another agent. Every time I talk to somebody new in financial services and retirement, I always recommend your body of work as a must read, because you've done an incredible job with this. And I want to dive into a lot of these things. I got some great questions, but to kick things off, I just want to know, David, because your background, you were helping people as an advisor, and then you left that practice to go around the country and really raise awareness as to what's happening. What made you do that?
Well, yeah, so a lot of that happened concurrently. I was sort of this transition period where I was meeting with, holding 20 different meetings with clients and prospects per week. And I was being asked to do a lot of speaking engagements across the country, particularly after the launch of the Power of Zero in 2014. It just got to the point where I got so many speaking engagements. You sort of have to make a choice. Do you want to be meeting with clients, or do you want to be sort of getting the message out? And it was really hard to do both at the same time. It's not like I can't walk in and chew bubble gum at the same time, but it's a really, really big commitment to run my organization. It's called Power of Zero. I got a lot of advisors, got about 250 advisors that use my marketing program. So it's really tough to wear a lot of different hats all at once. So I think about probably 7 or 8 years ago, I just made a choice that I wasn't going to be meeting with clients and prospects as much. I still do some of those client meetings, just not nearly as many as I did before. And as you know, I've got a pretty strong YouTube presence. I'm putting out 2 videos per week, and that's in and of itself practically a full-time job. You throw the speaking engagements and writing books on top of that, and it can be overwhelming. If you were to throw, meeting the needs of a clientele on top of that, Power Zero planning is very proactive. We're very intentional. We're doing Roth conversions every single year, so it can be very, very active. It's not a passive approach to retirement. So it'd be tough to do all that at once. So I just sort of had to make a decision on which types of things I wanted to focus on.
Well, on behalf of people that work in the industry, I want to say thank you to you for making that choice, because you've impacted so many lives. And the way you explain things is just masterful. You're so intentional with your language. And I watched a lot of your videos. I was extremely impressed with your content game. You have gone to the next level on YouTube, and the content you're putting out is so relevant and incredible right now. I was really impressed by how you're consistently putting things out there for people and the consumers to get educated on why this message is so important. Let me ask you, that leads to my next question. Why is the Power of Zero message so important for people to be understanding and practicing right now?
Well, because the paradigm shift is sort of going on here. Historically, when people save for retirement, they put money into IRAs and 401ks. They do it because they love the tax deduction. It's basically conventional wisdom is you're going to be in a lower tax bracket in retirement than you were during your working years. And I think that has been the case for a huge part of history. If you look at the decade of the 70s, highest marginal tax rates were 70%. If you look at the early 60s, highest marginal tax rates were closer to 90%. In the wake of World War II, the highest marginal tax rate was 94%. So there was this idea that you could get a deduction of those much higher rates, and then in retirement, you would retire at a lower rate. And mathematically, the math worked out. Well, we're sort of marching into this future where the national debt is growing so big, and it's going to grow bigger due to unfunded obligations for things like Social Security, Medicare, Medicaid, that are driving the debt higher. We're getting to a point mathematically where tax rates, according to all the independent studies, all the independent experts, tax rates have to rise dramatically by 2030, or we go broke as a nation. So the paradigm we've adopted in the past vis-a-vis retirement planning has been flipped on its ear. And so we're now, if we want to wring the most efficiency out of our retirement dollars, we have to do precisely the opposite of what we've done in the past, which is pay taxes at today's historically low tax rates, so that by the time we take those retirement dollars out somewhere down the road, we've done all the heavy lifting, we can then take those dollars out tax-free.
Makes perfect sense. A lot of people are concerned about higher taxes, and obviously you have the national debt to point to, and you have a lot of people that have this kind of palpable fear. What do you tell people that are concerned that their retirement accounts are going away? Or, I mean, how do you encourage people during this time to take action and be brave, but not paralyzed by fear?
I think the key here is you worry about the things that you can control. You don't worry about the things that you can't control. What can you control? You can control the type of account within which you are accumulating retirement dollars. You can control the timing of the tax payment on your retirement dollars. So when it comes to Roth conversions, you have to ask yourself the question, are you likely to pay a higher tax today, or higher tax somewhere down the road when the IRS forces you to take those dollars out? I think more and more people are coming to the realization that a bird in the hand is worth more than two in a bush. We are at historically low tax rates. Independent experts, third-party experts like former Comptroller General of the federal government, David Walker, predicted that tax rates have to double by 2030. He did that in his book, Come Back America. This is a guy that knows more about these numbers than anyone else on the planet. And he's saying, look, tax rates have to double or we go broke as a country. We will not be able to afford to pay the interest on the national debt, the money we've already, the money we're renting that we've already spent, right? So I think that we worry about the things that we can control. We don't worry about the things that we can't. And what can we control? We can control the timing of the tax payment on our retirement accounts.
That's well said. I want to dive into your body of work. So you got Power of Zero, which was the book that put you, your first book, put you on the map. And then you came out, this was 2019, I believe, with the Power of Zero movie. And what was the deal with this, David? It was the first financial film to ever get like a rating, like a PG rating. Was that the special thing that was so, yeah. I mean, the video is incredible. The documentary is amazing. But what was the deal with the rating again? Remind me, please.
Gosh, I got to remember. I think that the fact that it's rating just gives it a greater sense of legitimacy. I think the reason it got PG versus G is because you're dealing with sort of some adult themes, this idea that tax rates could rise to apocalyptic levels. And really the whole purpose behind that movie was we would have people, we would go through all the evidence for rising tax rates, and they still wouldn't believe them. So we said, we've got to put together a documentary where we interview all of the most important experts in the nation on the national debt as it relates to the future of tax rates. And let's let these third-party experts speak for themselves. And by the time you finish that movie, there is no doubt in your mind that tax rates have to rise in a dramatic way in order to pay for unfunded obligations like Social Security, Medicare, Medicaid. There's just no doubt. And these are the most important experts in the nation that are chiming in on this. So that was really the motivation behind that movie.
Yeah, by the way, anybody watching this video right now, financial professional, consumer, if you have not read this and seen this, it's a must read, must see. I talk about these all the time. I buy these in bulk. I just took a ton of clients out to dinner to say thank you, a special group. And that's in a rural part of Arizona that I don't get to see as often as my regular clients that are right by my office. These two were sitting in front of everybody's place setting at the restaurant, because as a financial professional, the challenge is, how do we inspire people to take action to help them proactively? And so we have all this information and we got to try to communicate that in a brief 20, 30 hour long meeting. But this video just does it so well. So I highly recommend both of these. Now, those are strategy, in my mind, a book and a video about overall strategy, economy, what's happening, and why people need to take action. I want to talk about these two books for a second, because you wrote these, and now we just had all these interest rate increases since these have come out. So what's significant for people to know if they're trying to find the right LIRP, if they're trying to find the right piecemeal Roth conversion strategy for their IRAs using guaranteed lifetime income from annuities? What's significant about these interest rates that's important for people to understand right now?
Well, so for Index Universal Life, interest rates are what drive the option budgets for insurance companies, and that determines the level of caps. That determines the level, the extent to which you can participate in the upward movement of the stock market index, which is, the cash value in those index universal life policies are linked to the upward movement of that stock market index. So higher interest rates means insurance companies can allow you to participate in more of the upside of those caps. And of course, when it comes to annuities, higher interest rates means you can take higher distributions from those annuities when it comes to guaranteed lifetime income. So it's really getting to the point, it was sort of tough going there for a while when the federal interest rates were at or near zero. It was really tough to come up with an option budget to be able to sustain higher cap rates in both of these types of products. But we're now getting to the point where rates are starting to return to historically normal levels, which is good. On the one side, it's good for products like Index Universal Life, what I call the LIRP in my book, as well as fixed index annuities. But it's bad because, on the other hand, the cost of servicing the national debt is going to start to skyrocket, right? The cost of servicing the national debt, when the interest rates return to historically normal levels, it's going to triple or even quadruple. And so we're going to sort of reach that day of reckoning in our country even faster. So we sort of have to balance those two variables against each other.
Well said. So you have this opportunity on one hand with actual products like financial products, but on the other hand, it's accelerating the problem that you outlined in Power Zero. So you really need to be taking action, is what you're saying, I think, is you got to be really mindful right now. It's not a time to be complacent.
That's exactly right.
Okay. So let me ask you a question, and this may be too personal, so you can pass on this one if you want, but like, what do you prefer, David? Like, for your retirement strategy, like, what do you like, the LIRP? Do you like the piecemeal Roth conversion? Is it a balance? Like, what do you try to achieve?
Yeah. So you got to remember, I live in Puerto Rico, where I don't pay tax. Well, I pay very little tax. That's just part of the benefits of living in Puerto Rico if you're a qualified company. And so every dollar that I save, I don't pay any capital gains tax on. So it feels like a massive Roth conversion. A massive Roth IRA. So I'm probably not a good person to ask in terms of, hey, maybe I could do exactly what David McKnight is doing, because so long as I'm in Puerto Rico, I don't pay any tax on any of my investment gains.
Wow. I always wanted to ask you, is that why you're in Puerto Rico?
That's about 90% of the reason why. The other 10% is, I've got 7 kids. I really wanted to expose them to a different cultural situation that sort of took them out of their comfort zone a little bit. But that was the primary motivation. They waive your federal tax, they waive your state tax, they charge you a flat 4% tax. So it feels like, basically they're knocking a zero off your tax bill. Now, so the trade-off there is that there's not all of the niceties that you experience in Arizona or other parts of the country. A lot of potholes, a lot of hurricanes, a lot of blackouts. But we've come to love Puerto Rico, and so yes, I utilize the LIRP. I don't have any fixed index annuities at this stage in the game, but I'm sure that the closer I get to retirement, the more I'm going to take a hard look at shifting some of those, some of my retirement accounts to fixed index annuities. So I'm not the best guy to look at in terms of mimicking my plan, but certainly the types of things I talk about in the Power Zero, in tax-free income for life, are types of things that I believe in and I recommend to my clients and prospects.
Well, and I think it's so important. You're operating in a different country. I mean, you're not operating in the same problems that we're operating in here. And as a successful entrepreneur, I think that's the more powerful message, that being the guy who studied the tax rates and what's happening in our economy, probably more than almost anybody up there with the economists. You live in Puerto Rico. I think that's interesting to note. So I think that's the takeaway there. So thank you for sharing that with me. I have one question for you too. Because looking at LIRP, I know that's for people who are like us, who are still saving for retirement and building in the building phase. But, do you ever recommend, like, as a Power of Zero message, or, just with your advisor network, do you guys ever recommend like a modified endowment contract for anybody at any stage of retirement? Yeah.
So there are instances, there are a couple of companies that have great sort of single premium index universal life policies that I really love. They're great CD alternatives. I've got members of my immediate family that utilize that type of strategy. So I mean, you can the thing with Index Universal Life is the more money you can get into the contract earlier in the game, the more that money can build a head of steam and sort of build momentum. And particularly when it comes to these modified endowment contract, the net amount at risk, the amount of insurance the insurance company requires you to have, or the IRS requires you to have, is not all that much. And so it can be a great way to get between 5 to 7% net of fees over time without taking any more market risk than what you might be taking in your savings account, for example. So it's a great, safe, and productive way to grow at least a portion of your assets. Now, the key there is that the money will go tax-free to the next generation, but if you take money out while you're alive, you are going to pay tax on a you can pay tax on the first distributions that you take out. So you've got to be mindful of that, but it can be a great savings account alternative, CD alternative. Is certainly something that we recommend.
Okay, that's cool. I like that. Yeah, I like using the MEG for my clients individually. And I wrote about a strategy where you could have an index universal life policy or some type of cash value policy that's growing during the accumulation phase. And then when you get to retirement, you could potentially 1035 that to a single pay MEG. And so that kind of has some unique privileges that kind of work together. So I didn't know if you support that message, or I mean, not the message, but I mean, if you support that strategy or if you use that strategy, that's cool to know. I never gleaned that from getting to read Lurk, because it's more about the accumulation phase, I feel like. So look before you look. Okay, I'm going to throw four scenarios at you. And I just want to know if this aligns with the philosophy that you teach and you help the country with, or if these are things you shy away from and why. So let me just throw these at you and see what you think, if it's okay with you. So what do you think about using LIRP loans to pay the tax on the Roth conversions? Yeah, that's not my favorite thing to do. Okay. It's maybe a little bit more aggressive. Generally speaking, I like to pay the tax first option that I like the best is to pay the tax on a Roth conversion out of a taxable investment. So the math seems to work out the best if you pay the tax out of a tax. So for example, let's say you're doing a $100,000 Roth conversion. You've got a $20,000 tax obligation on that. You've got $100,000 sitting in the savings account in your taxable bucket. The math suggests that you are better off paying the tax on that Roth conversion, which is the $20,000, out of that taxable bucket. That allows you to get the full $100,000 into the tax-free bucket, so you can then grow and compound those dollars over time. I know there's lots of different strategies that people advocate for using the LIRP that can get pretty complex. I'm a pretty simple guy. So generally when it comes to LIRP, I stay pretty conservative. I like that. Well, you have a framework. You're serving people in the masses. You really need to give people the basics. You can't get, too advanced or aggressive in a kind of a general educational video. So that makes total sense to me. What about the strategy I'm hearing a lot about, where you use a HECM and you take the proceeds from the HECM to do the Roth conversion? What are your thoughts on that? So HECM, similar to a home equity line of credit? Yeah, it's the, I'm sorry, I apologize for the acronym, the home equity conversion mortgage. It's like the reverse line of credit. So you got somebody who's 62 and they have a reverse line of credit on their primary residence. Gotcha, so like a reverse mortgage. Yeah, like a reverse mortgage. Yeah, what are your thoughts on the reverse? Yeah, I'm a little bit more partial to that. Okay. In fact, you and I met at a meeting where I think reverse mortgages were discussed. Yes, that was the meeting I was referencing. At Fairway. Yeah, so I'm a big fan of reverse mortgages in the sense that only 1% of children want to inherit their parents' houses, right? They would much rather receive cash, and so if there's a way, instead of having your parents spend all of the money that your kids, all of that those liquid savings that your children would prefer to inherit, if they could spend down the equity in your house in the meantime, let those liquid savings continue to grow and compound over time, and then pass that on to the next generation. That's a much better way to do it. And certainly if you can take some of that equity and use that as a catalyst to get even more of your tax deferred savings into the tax-free bucket by way of that Roth conversion, then that's something that I would think about recommending. Yeah. Okay, so that's two. So scenario number three I want to ask you about is you see a lot of financial advisors that, tell people, well, don't pay your Roth conversions with your money. If you have some, maybe like a brokerage account that's after tax, you could put like a line of credit against those assets, and you could use that to pay the tax on the Roth conversion. What are your thoughts on that?
So use a brokerage account as collateral for a line of credit?
Yeah.
Is that, yeah. I have actually.
Is that in the too aggressive camp?
It might be. And
I'm coming up against that a lot lately. I'm hearing a lot of different advisors preaching that philosophy. I just want to get your thoughts on it.
And people have been recommending that in the historically low interest rate because they're trying to take advantage of the arbitrage. Is that what they're doing? Because the cost of that money, it's tax deductible, and the cost is historically pretty low. Yeah, I understand. I understand the arbitrage behind it. It's a little bit outside of my comfort zone in terms of how conservative my philosophy is that I'm trying to convey to the masses here.
Sure, that makes sense. Okay, that's good. Last one. When do you use a QLAC? Like, where does that fit in? Does that ever come into play in terms of helping people with, some of this, tax diversification or kind of more control over when you pay your RMD?
Yeah, I have not used those a lot, to be honest. That's not really been part of my message. I'm sort of familiar with how they work, but it really hasn't come into play with the type of planning that I do.
Yeah, a lot of the benefit of doing these videos and why I love this and why for me it's a very selfish thing is I just love getting to spend time with you and ask you these questions. And so for me, I found it the same thing. It's not, I do a lot with annuities for people in retirement, but the QLAC, it doesn't seem to have a place yet at the table that I really find that serves a lot of people. And so I'm trying to figure out, where that applies best for people. So I want to get your thoughts on that.
It seems there were some changes to the QLAC in the most recent Secure Act 2.0, if memory serves, but it's just never really been something that I've really recommended as a pillar of Power of Zero philosophy or strategy. So
is there an age between look before you LERP and tax-free income for life? Like, is there a kind of a transition age that you kind of have as a barometer of like, okay, once you're in a certain age and you're in terms of where you're at for preparing for your retirement income, we might switch from the LERP over to, and again, I understand from watching your content, if you haven't seen David's videos, I highly recommend you check out his YouTube channel, but he really recommends, I think it's 5 or 6 different sources of tax-free income, and life insurance is one of those. You have a lot of different areas you try to exhaust and explore and help people with first, but I'm focusing on this because that was my question is like, with that one, when do you kind of make that switch for people? Like what age?
Yeah, most of my clients and most of our Power of Zero advisors clients are 57 and older. We don't stop recommending LIRP until they're maybe 67 or older. And really the primary, I would say 70% of the time, the motivation for which people have LIRPs is because they love this idea that you can get your death benefit in advance of your death for the purpose of paying for long-term care. That is a huge motivator because think about it. If you're between 57 and 65, you're a married couple, what do you have 4 of? You have 4 parents. And what's the likelihood that one of those parents is going through a long-term care event even as we speak? It's a pretty high likelihood. And so most of the people that we come in contact with for the first time are asking themselves, one of the foremost thoughts they have in their minds is, how do I avoid going through what my parents are experiencing right now? And what could their parents be experiencing right now? They may be spending a couple of months between each children. They may be in a Medicaid funded facility. They may not be getting the care that they really hope that they could get. And so people aren't opposed to having long-term care insurance. They're just opposed to paying for it. And when you show them a plan, which is the LIRP, where they can grow money in a tax-free way, but then they can get at that money during their lifetime and they can get the death benefit during their lifetime for the purpose of paying for long-term care. That's a very, very attractive proposition for people who up to that point had been contemplating traditional long-term care insurance, which is a use it or lose it proposition. You pay for 30 years, die peaceful in your sleep, never having used it. They don't send you any of your money back at the end. And that can be a source of heartburn for a lot of different people. So, this is a very attractive strategy for people, you know, all the way up, I would say, till age 67 or so. Once you get to 67, it's really sort of tough to be able to build a head of steam when it comes to building that cash value accumulation. But and plus, the older you get, the less healthy you are. So the LIRP sort of falls off the table for a lot of those older couples. But that's sort of that age 67 is when we start transitioning away from the LIRP, I would say.
That's great. Thank you for answering. I appreciate it. I was curious. How are you guys helping people to avoid IRMA?
Yeah, so that's so the question with IRMA is, you know, you end up paying all these extra, you know, Medicare expenses when you do Roth conversions. Is that sort of at the heart of your question?
Yeah, you know, people are coming up against this. I keep running into clients that I meet, new people that are like, oh, I just got this letter from Social Security and I got a surcharge because I sold a property, or I did a Roth conversion and now I got an IRMA. And, you know, it's like, yeah, I know there's limits that you can operate under. And so I'm sure people are just going over those limits and not really looking before they're transacting in certain taxable areas. But, you know, I just was curious as to like what your kind of guidelines are. Is it just kind of stick to the limits, or are there other ways you can help people to avoid getting in that situation, maybe more proactively?
Yeah, so there's a trade-off there with IRMA. On the one hand, if you undertake Roth conversions, you're going to increase your taxable income. You're going to increase the income that's subject to those IRMA guidelines, and you could potentially pay, you know, get a surcharge, you know, on your Social Security, and that can hurt because it can add up to a lot between you and your spouse. But the thing that you have to weigh that against is this idea that if you can get at or near the 0% tax bracket in retirement, you could put yourself in a position where you get your Social Security tax-free for the rest of your life. So it's not just, so a couple of years of IRMA during that Roth conversion period. So the trade-off is that you get Social Security tax-free for the rest of your life. That's a pretty big deal because a lot of people are losing between $4,000 and $7,000 per year of Social Security. And if you get your money into the tax-free bucket, you've insulated yourself from the impact of rising tax rates over time. And so that's a pretty big deal. So not only are you protecting yourself from tax rate risk, you're protecting yourself from the effects of Social Security taxation and all the opportunity costs that goes along with that. So yes, the cost of admission to get into the 0% tax bracket sometimes is you got to be willing to pay a little bit more tax in the short term, be it income tax or IRMA, but the payoff over time can be pretty dramatic. And we've got calculators we use to figure out do it versus don't do it. And almost every time the math says that you should do it.
David, I'm so glad I asked that question. I had a huge paradigm shift listening to talk. You can tell even the way I asked the question, it's like limited thinking, like how do you avoid an IRMA? You're saying, no, flip that. And there's a benefit there on the other side. Like think about the cost of admission. That was well said. That was valuable for me. Thank you so much. I appreciate that answer. That's impactful. All right, my last 3 questions are more fun. So other than moving you and your family and business to Puerto Rico, I know you have some really conservative philosophies. You got a great framework that people can study and use and operate well. Do you have anything kind of special or fun, or maybe a cool thing that you've come across that might be a good tax reduction, deduction? I know there's not like this magic list of deductions that you can go reach and pick, but is there anything special that you might want to, that you have that kind of could be cool or fun to share with like maybe business owners, or something they could do to give some acceleration to their strategy, or something kind of cool to consider, even if it's not something you're recommending, just maybe like philosophically an idea that you've come across that might be cool to share?
Yeah, that's sort of an interesting question because my strategies typically cause you to pay more tax today versus less tax today. So my paradigm has always been, how do I convince people that it's okay to increase their tax bill in the here and now versus lower their tax bill in the here and now? But one little strategy that I would share with you that people need to think about is if you've got a lot of money in your taxable bucket, let's say you got a couple $100,000 in your taxable bucket and you hit retirement, okay? It might be a good time to live off of your taxable bucket, which could be very little, if any, tax implication for doing so. And then in the meantime, execute a Roth conversion so that you can take advantage of the standard deduction, take advantage of the 10% tax bracket. You can take advantage of the 12% tax bracket. And, that's going to get you over $100,000 of Roth conversion that you could get shifted to tax-free every year that you're living out of your taxable bucket. And so a lot of people don't want to do Roth conversions in retirement because they're like, I'm already taking money out of my IRA to meet my lifestyle expenses. If I do a Roth conversion in retirement, I'm going to be piling that money on top of all my other taxable income. Well, guess what? If you can live out of your taxable bucket, that will lower your tax bracket down to zero. And then when you do that Roth conversion, you can take advantage of, this year for a married couple, $27,700 of standard deduction, where you don't pay any tax at all. You pay zero tax. And then you pay 10% and then you pay 12%. You could get over $100,000 repositioned to tax-free simply by choosing to live out of your taxable bucket versus your tax-deferred bucket in retirement.
Wow, that's a powerful strategy. Thank you for sharing that with me. All right, last I want to finish up with, I want to talk about this book because this really impressed me. Like, I want to know, what was your inspiration behind this? If this was like, if you were like, all right, I'm going to build the value for people, because I've always known you as a great financial author, and I love the way you communicate very complex, big economic problems and ideas and strategies into this like bite-sized ways for people to just easily read a quick book you could read on like an afternoon and then go, wow, I could really make some changes to my future. But then this comes out and I was wondering, like, did you go to your wife and you're like, all right, it's time for the passion project? Like, I read this and I was like, David's a serious, I knew you were a serious author, you're a best-selling author, huge publishing, incredible. But then I read this and I was like, he's a talented author. And so I want to know where this came from and what was kind of the inspiration, if you had this one kind of tucked away and it was just time.
Yeah, I appreciate that. I'm actually much prefer to write fiction than I do, another boring business book. You've read The Volatility Shield. I really enjoyed writing that book as a financial novella with a financial principle couched within it. But really the genesis of this book was, I got really concerned when certain economists, and there's really one in particular, her name is Stephanie Kelton. She was Bernie Sanders' economic advisor during his run. She's the foremost advocate for what we call modern monetary theory. And modern monetary theory suggests that if you as a country denominate debt in your own currency, then you can simply accumulate as much debt as you want because you can always pay that interest on that debt with your own money. You can keep printing money to pay for as much debt as you want. And so this is sort of runs counter to this idea that we should keep our fiscal house in order, that we should have, we should take measures to reduce the national debt because the cost of servicing that debt will drive tax rates up over time. And so I've long been preaching that the national debt is projected to soar to unsustainable levels. And then along comes Stephanie Kelton that says, the title of her book is The Deficit Myth. In other words, deficits don't matter, debt doesn't matter. Well, never mind that, all of the most important economists in the nation have said that that's a bunch of hooey, that debt does matter, that debt will drive interest rates to unsustainable levels, and tax rates will have to rise dramatically as a result. So what I wanted to do is I wanted to sort of answer Stephanie Kelton, but I didn't want to do it in the traditional way. I prefer to write fiction over nonfiction. So I said, hey, is there a way I could write a story, the main theme of which modern monetary theory is a bad idea, but do it in a Dan Brown, suspenseful, psychological, it's not a psychological thriller. It's a thriller, it's a suspenseful novel in a way that engages the reader and conveys the general concept of the dangers of modern monetary theory, but keeping the reader entertained along the way. So that was really the idea. And my wife says, okay, this is during COVID, you can write a novel, but it's got to have something to do with your work to justify it. So I said, okay, I'll find a way to make it.
Nice. It's good. It's good to have a great partner that can help keep you grounded and kind of keep you in one lane once in a while. I definitely need my wife to help me with that as well. So my last question, David, thank you. But so just your time. So what's next? Is it going to be, do we have another book like this coming? Do we have another video? Do we have what's next on the horizon for you and the Power Zero?
I've always got a couple books cooking in the back of my mind. I haven't settled on one in particular, but I'll tell you what, this YouTube stuff is like a full-time job. So
yeah.
I just have really taken to YouTube like a duck to water. I love, I love creating videos and it allows me to address issues in a really relevant and current way. It allows me to sort of speak my mind on specific niches of the industry or of retirement planning. And I just love engaging with people who watch those videos. So the plan for right now is to continue to put out relevant videos on YouTube. And we also push those out to other, to our social media platforms as well in little smaller bite-sized chunks. But that's the plan for now. But there's always something cooking in the back of my mind. So we'll see how that coalesces over the next few months.
Nice. Well, you know me, I'm first in line to support whatever comes out next. And I appreciate your time today, David. Thanks for joining me. David, what's the best way for financial professionals, consumers, anybody to come find you? Where do you want them to go?
Yeah, just go over to powerzero.com. And if you're a consumer, that'll sort of funnel you to the right spot. If you're a financial advisor, that'll funnel you to the right spot. So powerzero.com is great. Of course, my YouTube channel is the Power of Zero. So feel free to go there and subscribe to the channel, and you'll get a couple of videos every week.
Definitely. Yeah, I'm going to put the links to both of those down in the description below. If you like this video, please take a minute and actually hit the little like button. It helps me to reach more people, helps me to bring on incredible, amazing guests like David. Think about subscribing, please. I would encourage you to do that as well. And then head over to David's channel and subscribe there as well. It's well worth it. I watched as many of those videos as I can. You're putting them out so fast, it's hard to keep up to watch them all, but I watch as many as I can. They're incredible. And please leave a comment. David and I will get back to people who have questions or want to expand more on any of these thoughts or ideas that David shared. We will respond to all of those comments. Thanks so much for watching. We'll see you in the next video.